Welcome to the Salty Investors. It is Thursday afternoon, November, what is it? 16th.
Yep.
Episode 57.
Mm-hmm.
How you going, Tim?
Oh, I got a bit of a cold. I'm sweating here a little bit. What about yourself?
COVID? Have you COVID tested?
Not sure.
No.
Maybe. Who knows? It's going around a bit,
Yeah.
isn't it? I reckon.
Well, it is going around, but I mean, at this point, how weak it is basically a cold, isn't it?
Yep.
For, strapping healthy young lads like us.
Yeah.
So, I've had some trials and tribulations in the last week, but, could be worse. Could be worse.
Mm-hmm.
What do you got for us this week with salt, Tim? Give it to us.
Meat prices are not coming down in the supermarket. Farmers and David Littleproud, the leader of the Nationals, has been fear-mongering about this stuff. Yes, farmers might only get $4 a kilo for lamb, but there's a heap of processing, storage, transport, and distribution costs. If there are price gouging, farmers, should set up their own processing and distribution and take advantage of this, besides complaining to the ACCC, which won't do anything anyway. Many farmers even sell direct to customers nowadays, and their prices haven't decreased, so that proves this is total BS. David Littleproud should do better than fueling disinformation. Have you heard about this?
Yeah. I mean, well, Littleproud's just, I look after the rural people, it's just the standard Nationals line, isn't it?
Yeah, but he's well educated. And I've spoken to people that know him in that area, and he's not a dummy. He knows about economics and he knows how things work. But he's just playing politics here, and I don't know. When you lose credibility with me, it's sort of pretty hard to get back. But I don't know. People love to play these games in politics, don't they? They seem to act stupid when they know better. So.
Well, that's why you and me would be terrible politicians. We'd be like, yeah, that's the market, dickhead. Get over it. Yeah, go out and start your own processing plant then, or just sell it straight direct to the customer. You got options here.
Yep.
Stop whinging.
Yep. Yeah. You got any salt for this week?
Oh, yeah. So the Minister for Climate Change and Energy, Chris Bowen, has been smugly running around reposting on X every 6 hours the failure of a small modular nuclear reactor project in the US. Now, why is he doing this? Because this is the technology that the coalition's been spruiking as an alternative for Australia. Now, despite being in power for 10 years, the coalition didn't even mention nuclear until the last 12 months, so I don't actually care what the coalition thinks. But Bowen should pull his head in a bit, because the majority of Australians in recent polling are in favour of nuclear energy. And furthermore, the failure of this particular project is not an argument against, firstly, lifting the ban on nuclear energy in this country, which is ridiculous, and nor is it an argument against nuclear power in general, especially since Labor's net zero fantasy target is laughable and will likely be vastly more expensive than forecast.
Yeah. I saw some of these other data about, they equate the life of a nuclear power plant very similar to the life of a solar farm, and solar panels. It's
right.
Like, they've got some nuclear power plants been going on 50, 60 years in the US,
Yeah.
Have you ever heard of a, solar panel lasting, 20 years?
That's just nonsense.
Yeah. And
yeah,
when you do your DCF or whatever you're doing, you put in 10 years for both of them. Oh, look, nuclear power is more expensive.
Yeah.
You're not being realistic with what happens in reality, but I don't know, just people playing games again.
Yeah. There's a guy on X who's worth a follow. His name is Aidan Morrison. And I think he's a physicist or physics. He's something like that. But he's just been going through all of AEMO's projections about how much net zero is going to cost, and he's found all these flaws, and they're hiding costs or not accounting for costs. I mean, it's egregious. And he's just been on a podcast called Fresh Economic Thinking, which is Cameron Murray, who's a economist. So he's well worth a listen if people want to have a listen, because net zero is a fantasy and it's going to be way more expensive than anybody thinks. So let's move on. The big news, I don't know if you noticed, Tim, in the US, inflation is dead. It's all over. So in October, Was it October? Yeah, it was.
Mm.
So inflation, where am I? Is that the right one? This is the one I wanted to look at. So inflation as a whole is 3.2%. Core is 4%. The Fed's at 5.25%. They're done, aren't they, Tim? They're done.
Well, they're doing a better job than us. So
yeah, we're still we're the other way round.
Yeah. So
I mean,
higher rates actually do decrease inflation. Who would have thought? You know, like you want to like put some brakes on the economy. It actually works. Well, MMT guys must be freaking, like pulling the hair out, going, "Wow, this shouldn't be working at all." Like, we can. But yeah, obviously it's slowing things down. But yeah, that's looking pretty good in the US. Like, another 6 months of that. As you see from the graph here, it's going to be down in that 3 range, even lower. So could be touching 2. So
yeah, and the market got a bit excited about it. Yep. Declared the end. This is from David Rosenberg. This is Powell's preferred measure. Oh. Core services ex rent of primary. It's I don't know the way they come up with these measures. It's now under 4, slightly under 4. But this is another thing that Rosenberg put out. Every time the Fed funds rate peaks, followed by a recession. Oh, what about 1995? Maybe that doesn't count. I don't know what's going on there. Anyway, I guess that is the peak there, really. But so just something to look out for. This is something that John Hussman's very good on. He's actually said that people seem to think that once they start cutting rates, then the market just goes off. But I mean, remember, through like the financial crisis was a perfect case in point. I mean, they were cutting all the way down here, and the market still went down 56%. The S&P. So
they're cutting for a reason.
Yeah, there's a reason they're cutting. They're not cutting just because it's great times. That's generally not why rates are getting cut.
Yep.
And speaking of Hussman, so this is all historical experiences. Estimated 12-year S&P 500 total return in excess of Treasury bonds. You are here, down here, right now, compared to history. Now, of course, we've been through this before. This time is different. PEs are higher and returns are higher because technology stocks, blah blah blah. All of that. So
China
doesn't necessarily follow. But this is not historically where stocks do their best vis-a-vis bonds. It's just not the case. Little reminder there. It's probably more of a it's me once again just playing into my own bias of trying to find things to make myself not feel bad.
Yeah, I know. It's good to see them, but yeah, like you'd rather be in the middle of the pack there somewhere than, Buffett's still not allocating. He trimmed a bit. If you saw his 13F, he's trimming a little bit on everything. So,
yeah. I mean, you'd at least want to be over the zero line, wouldn't you? Excess return over Treasuries, because where's this equity risk premium?
Yep.
Anyway. Oh yeah. So this is Aussie. Anything else to say on the US? What do you think? You think they're going to start cutting earlier than everybody thought? What do you reckon?
Sort of the problem is I'm with the consensus now. Higher for longer. That's the problem. And like far out, everyone's on this band rate. And So, but how long they're going to keep it there, I've got no idea. But yeah, it looks pretty good in the US. As long as people don't move, they're still going to have money. The economy's, jobs numbers are still fairly good. I know it's softening a bit, but it's still very nice in the US. Compared to here, where the increased interest rates, it affects, people's disposable income very heavily. So,
So this is Australia's wage price index.
Okay.
So it's up year over year, the highest we've seen in a long time, about 4%. And of course, Jim Chalmers, the treasurer, is out saying, "Look at this. This is the highest wage growth we've had in." Hey, Jim, what's the inflation rate? 5.2 versus 4. That means you're still going backwards. Australia has had the worst decline in living standards for more than 30 years. And Chalmers is out there celebrating.
I see people, they go and interview some barista or some guy working in a cafe store, and he goes, yeah, I feel my pay's gone up a little bit, but not as much as what I pay for stuff. So the common man can even understand it. So it's a bit worrying for Jim, I think, when the common man's not, thinking he's getting a pay rise for nothing.
Yeah, and I hate the dishonesty of it. It's that condescending contempt for the average Australian. You say, look, wages are up 4%, but don't mention inflation. Like it's just such dishonest bullshit. So let's get to the stock of the week. It's Technology One, another Aussie quality stock, or is it, Tim?
Yeah, well, we're sticking to the same narrative, trying to look for something, a bit of quality in our backyard. Technology One is an ERP company, which stands for Enterprise Resource Planning, which might seem like a nothing term, but basically it's the base software for medium to large organizations. They look after accounting to marketing to basically everything, and they've got 400 modules to help customize a solution that's got a fairly common code base to keep development costs down to a certain degree. They power 60% of Australian and New Zealand universities and 73% of local governments in Australia and New Zealand. And they're extremely sticky and nearly impossible to switch to alternatives. When we look at, they've got other verticals like health, finance, and projects, but they're much smaller penetration. The TAM is massive, and they say they're only servicing under 15% of each vertical, but clearly that isn't realistic. As I just mentioned, the numbers before. They're transitioning from an on-premises software to a SaaS business, so in the cloud, and that's upticked their churn rate to a little bit under 2%, but that process is nearly complete, and I expect that to go down to 1% or lower. They're targeting a new market in the UK, which is fairly smart, as it's fairly similar to Australia and New Zealand. But I think they've left their run a little bit late. The US would be a great market, but extremely risky. And now it's held by alternatives in that market that are extremely sticky also. As a side note, John McTaggart owns 7.7%, and he's the co-founder and chairman of Brisbane Angel Investors and a director of Technology One. Brisbane Angel Investors invested $440,000 into ChipChamp and has sold last year to Microsoft for $11 million. So clearly they've got a lot of talent on hand. He obviously travels in very similar circles to us. I thought I'd mention it. Let's have a look at the fundamentals. Shares outstanding are diluting, which is a concern as it's a fairly mature company. The PE and price to free cash flow are extremely expensive. Return on invested capital and margins are generally great. Revenue and EPS growth are great and consistent, and they're showing how sticky the software is. It's got a small dividend and a large payout ratio. They have heaps of cash to cover short-term debt. If we flip over to the balance sheet and cash flow, we see they've got a negative debt of 140 million, which is very nice. Wonderful operational cash flow and free cash flow. No down years and double-digit returns for many years. Clearly, this is a wonderful business, but the growth for me is a little bit limited. Ignore the TAM junk they put in their annual report, as they're clearly running at 3/4 of their main verticals in local markets. For me personally, they should stop paying a dividend and take on the UK market, and this will return a higher return for shareholders long term. Look at the free cash flow returns, and I believe they can get that similar return in the UK market. A small dividend of 1.4% is nothing, especially when you tax at your marginal tax rate. Edward Chung, the CEO, has a heap of knowledge and key roles for the last 15 years at the company, and I think he can suffer a little bit of short-term pain for long-term gain. It's a great piece of software, very hard to move into larger markets, example the USA. And if they do, I think that'll be a red flag. They're just going to burn a lot of cash and maybe not get anywhere. For me, the growth isn't great, and maybe 2 times price to free cash flow. So that's a 16 to 18. And again, it needs a 50% discount off today's prices. Australians are totally nuts about this stock. What do you think?
Yep. Yeah, again, I mean, we're in the same situation where, yep, no problem. It's a great quality stock, but is it worth 50 times earnings? Is it worth 34 times cash flow? I wouldn't pay that. Like you said, I'm worried as well. I mean, okay, so there's probably some economies of scale to get out of going full SaaS, yeah.
Yep.
Rather than being sort of deployed on site. So I would assume that means less visits to clients, less personnel need for all that sort of stuff. So there's some costs to come out there. But as you say, like, this is a sticky type of business once you're in, and wherever you go around the world, the developed world, you're going to have incumbents already, aren't you, that are already sort of in there. I mean, Computershare back in the day in the 90s went into the UK very successfully because there weren't any, like, Computershare had best technology, right? They were and dominated the UK market, and then they went into the US in the early 2000s and they kicked ass there as well. But what are their chances? I mean, obviously they're good at executing, but it's another thing to go overseas and do it, isn't it?
Yep.
So
I think they said they've got like 70 members in the UK, and they're only bringing in like, $3 million worth of revenue or something. It's like,
right,
they're having a hard
so
time
there must
be
SMEs then. They must be small.
Well, yeah, there's lots of small councils over there as well, like Australia, but it's just hard going when, once they set up some software and they've already got it embedded and the software isn't that bad, and then you come along and go, oh, yeah, we're just going to use a little bit of better mousetrap. They're like, oh, just we're happy to stick with what we know. We don't want to train all these people that aren't too bright, that don't like change, But in Australia, once you've put the system in, I looked at their on-premises software. It looked like it was written in the 1990s. Like it was like, how do you sell this stuff?
Yeah.
People, and it's just like, wow, it's just because council have been using it for, a decade, and they can continue to use it. You're not going to switch to council over to something else. Like, you'd have to be pretty wild to do that. But yeah, that means it's a bit of a stalwart. It's not a high growth company. And if they try to go for the high growth thing, that's very risky. It'd be beautiful to be in the US market, but I just think they've left their run a little bit too late here. They shouldn't have issued a dividend, and they can execute way better and give me a 1.4% dividend yield. Just invest that into growth. I think they could still do that. That's what I'm saying to the CEO. If you're listening, cut the dividend, grow some balls, get out there, take on the UK market and really smash it. And that'll great long-term value for shareholders. But
well, there you go. Another quality find in Australia, but are you willing to pay up for it, folks? Let us know in the comments, and we will see you next time.